Hi everyone, Nick here, welcome back. Do you know how much your Social Security is worth? I'm not talking about monthly payments, but the total value of Social Security if you considered it like an asset in your portfolio. For someone in their 20s, it could be worth up to $200,000, and someone in their 60s, well over $500,000. For many people, it's one of, if not the most valuable asset for retirement planning. But people often don't consider it in their retirement planning or asset allocation. In this video, I'm going to show you how to estimate the value of Social Security and discuss why you might want to consider it in your asset allocation and retirement planning. Social Security is basically like a giant bond in your portfolio that starts making monthly payments to you when you retire. And they make monthly payments until you die. The average Social Security check for someone at age 65 is roughly $2,500. This is about $30,000 per year. Some of the major benefits of Social Security is it's inflation adjusted, so there is a cost of living adjustment, and only up to 85% of Social Security income is taxable. It could be much lower than that depending on your total income, but it caps out at 85%. For many people, this ends up being the largest asset they have in retirement. Think about the size of your portfolio you would need to provide that $30,000 a year in income, inflation adjusted, and after tax with some of that 15% tax benefit. Unfortunately, this is often missed in people's retirement planning, even though it's one of the most important and valuable assets. I generally think this is a mistake, which is why we're going to talk about how to value Social Security. What is a similar investment product to Social Security? The most similar one is an annuity, specifically a single premium immediate annuity. With one of these annuities, you pay a large upfront payment to the insurance company, and then they pay you a monthly income until your death. So let's figure out what it would take to buy an annuity that pays out this $2,500 a month in income for the rest of your life. I'm using a website called immediateannuities.com, which many people recommend. I haven't personally used it, but I've actually already done the math, and it requires $400,000. You can get income starting in 1 month. This is for someone that's age 65, that's a male in the state of Washington. It's pretty simple to get. You can click Get My Free Quote, and it's roughly $24.67 a month you'd get for the rest of your life. Once we know the value of the annuity, we can use that in a present value calculation. Now, this involves calculating the time value of money. Money you receive in the future is worth less than money today, because you could invest that money today and get a rate of return in the market. Depending on how you invest it in stocks, it would be higher than in bonds, but you have to use what's called a discount rate, which reflects your opportunity cost of what you could have done with the money instead. So figuring out which discount rate to use in a present value calculation is often one of the most difficult and the most important parts, since it drastically skews the results. So we're going to use this study from Vanguard, which studied historical returns from different asset allocations from year 1926 to 2019. When you're looking at annuities, it's probably most similar to a fixed income portfolio, maybe with a little bit of equity. But to keep it simple, we're just going to use as a baseline Vanguard's value here of 5.33% over this 100-year period. I've put together this spreadsheet to help estimate the present value of Social Security. There's a couple fields here that we can modify. First is the average yearly Social Security benefit. We have $30,000, then the taxable portion of Social Security, and the inflation premium. I'll put a link to this spreadsheet below. You can make a copy of this, tweak it, and see how it changes the results. For instance, if you're in a lower overall income, your taxable portion of Social Security might be 50%. So then on the right, we have the value from immediateannuities.com. I guess you could also modify this, but basically the price per dollar of yearly income is $13.27 for that scenario we had with the 65-year-old male in the state of Washington. We can estimate that that's roughly $400,000 now. when we adjust it for the fact that some of Social Security is not taxable, it's actually worth about $470,000. Now, I have no idea how to estimate how much value that inflation adjustment component of Social Security has. There aren't any inflation adjusted annuities on the market that I'm aware of to use for that comparison. So in my example, I'm just going to throw in a number of 30%. You can tweak that how you wish, but I'm going to say that's what the inflation premium is. And we arrive at roughly $600,000 that Social Security would be worth, that $400,000 annuity would be worth when you give it the benefit Social Security has from the tax and inflation advantages. Maybe we're overestimating that a little bit and we could bump the inflation premium down, but that's fine. So now I've put different discount rates here. So this was the baseline that we saw from Vanguard at 5.33%. So for a 25-year-old, we're using the present value formula from Excel or from Google Sheets. So when we use that formula, we can discount the future value of the Social Security to now, assuming we get a 5.33% annual return. We would only need $76,000 to get to that $600,000 of value by age 65. Then as you go left, the discount rate lowers and the present value increases because you wouldn't be earning as much every year from that investment. Then as you go down in each row, we have a new age, all the way down to 65. Since we're basing the value on when you're at age 65, it's actually equivalent for all the discount rates at 65, because that's when you would theoretically buy the annuity and start taking the monthly payments. But you can see even for someone who's, say, 40, it's a quite sizable asset. It would be a major part of their portfolio. Maybe a discount rate of 5.33% is a bit high because we've had pretty low interest rates recently. Although nobody knows what interest rates will be like in the future. It could be even higher potentially. So what you need to do when you're estimating the value of your Social Security, so you need to determine these factors. How much in Social Security benefit you're going to get. You can get that estimate from the Social Security website. You can estimate what the taxable portion of your Social Security would be. You could use some free tax software to figure that out, or just look at the tax rates. And then you have to estimate an inflation premium. That's really just your best guess is as good as mine. And then you have to pick a discount rate, and that makes a big difference. So what do you think you should use to value Social Security? Like if you had that money now and were investing it, what rate of return would you get? Now you have to remember that it is basically a fixed income investment. So you can't really use 10% like stocks because you don't have the money to invest in stocks. You kind of have to value it more like a fixed income investment. So I have a couple other sheets here that show how this impacts the asset allocation of people at different ages, age 30, 45, and 65. So let's imagine this 30-year-old person had a portfolio of $100,000. They were 90% in stocks and 10% in bonds. Well, based on the present value of Social Security for that person, I'm using roughly a 4% discount rate, so we're valuing it at $150,000. So once you include Social Security in their portfolio is actually $250,000. And if you consider that like a bond in the portfolio, it drastically changes the bond allocation because it's 60% of the portfolio. So as you age, the impact becomes a little less. In this next example, we have a 45-year-old with a $300,000 portfolio and a 70% stock, 30% bond allocation. In this case, we're estimating Social Security to be worth about $250,000. And that would be 45-year-old somewhere in the 4.25% discount rate maybe. So once you include that in the portfolio, it does still almost double the portfolio. It's 45% of the portfolio. That makes a massive difference on their actual stock bond allocation if you're considering Social Security like a bond. As you go to age 65, the impact reduces quite a bit because it'd be much less of your portfolio, possibly at that time. For some people, it might still be the majority of their portfolio. But in this example, let's say you have $1 million portfolio at age 65. You're 30% stock, 70% bond, and Social Security is valued at $600,000, still almost 40% of your portfolio. And that actually changes your stock bond allocation to 19% stocks, 81% bonds. It's still a pretty big impact on that size of a portfolio. So how does this impact asset allocation? How much stock should we put in it? Should we include it in our asset allocation? There's a lot of unknowns here. We were looking at the benefit amount could change, the tax rate on Social Security income could change. We don't really know how to value the inflation premium, and we don't know what discount rate to use. There's a lot of unknowns that can drastically influence the present value of Social Security. In addition to this, the government can change the rules and increase or decrease, most likely decrease Social Security benefits. And all of it makes it difficult to value exactly, but it does have a major impact on your asset allocation. There's different approaches you could use for valuing the Social Security. Maybe you want to be a little more conservative, use a higher discount rate, assume the government cuts the benefits a little bit, maybe they increase taxes to 100% of Social Security. These are all things you could do to be a little more conservative in your planning. But I do think it makes sense to consider it in your portfolio, in your asset allocation. Older investors might consider this, and maybe they're a little more comfortable with taking a little extra risk in stocks once they put Social Security into their asset allocation. Younger investors might actually want to follow this concept of leveraged investing, and I made a separate video on this. There's a concept called life cycle investing, where with that younger investor, Social Security was more than the size of their portfolio, and it's basically like a giant bond. So these economists or professors from Yale were advocating for potentially using leverage to increase the stock exposure when you're young, effectively diversifying your exposure to stocks over time. It's a very interesting concept. I'll put a link to this video below. That's something that younger investors might want to do, might make you more comfortable with having a larger mortgage, because the Social Security could be offsetting your mortgage debt. And it might make you more comfortable with 100% stock allocation. One thing I want to caution against is newer investors going 100% in stocks until you've experienced a bear market. You never know how you'll feel when you see your portfolio tank. I've seen friends of mine sell during the COVID downturn or last year, and then they didn't know when to buy back in and they missed out on returns. This can be much more detrimental to your portfolio than having a bond allocation, so you can see that balancing out your portfolio. Because you can't easily see Social Security buffering losses in your investment account like you can bonds. I made some other videos on risk tolerance and asset allocation, which I'll also link below, if you're trying to determine and figure out what your risk tolerance should be. The impact of Social Security in your asset allocation or retirement planning will be a lot different for retirees or younger people, or as you're aging. I'm really interested to hear in the comments below, what are your thoughts on if you should include Social Security in your asset allocation? How do you think it should affect it? How do you think it should affect your retirement planning? I tend to think we should include Social Security in the asset allocation, maybe in a more conservative form, using a higher discount factor, assuming Congress might cut the benefits some, and so on. It's just too big of an asset to ignore. Even though many people like to say, oh, I'm not counting on Social Security for anything, I think we need to count on it for something. It's unlikely it'll go away entirely. Thanks for watching, everyone. If you got value from the video, make sure to hit the like button, subscribe, and share the video with your friends. It really helps me out and supports free financial education. Thanks, later.